Wow, it's a big audience. Good morning, everybody. I know it's an extremely busy time of the year with Easter coming up, so thanks a lot for taking the time out to come and listen to us. My presentation very much is going to be on growing wealth, and I've divided up very much into two separate parts of the presentation. I'm going to talk to you about this monster, which is called inflation. And it's vitally important you understand the concept of inflation and why it's so important to you, whether you're growing your assets if you're young, but more importantly, when you get into retirement, where you don't have the security of earning an income, and you have to rely on what you've actually grown over your lifetime to rely on, inflation becomes a very, very big, important part of your life. So I'm going to explain what inflation is. I'm also going to talk about the current economic environment that we find ourselves in, because you'll see there's a lot of policy intervention about a lot of countries and central banks around the world, and that has had a significant impact in terms of what is happening in South Africa, let alone our own internal problems that we currently face. And then I want to talk to you a little bit about asset classes. So the only way you can actually slay this monster, which I call inflation, is to make sure that you invest your assets appropriately. And that is by diversifying them, putting them into bonds, equities, property, and cash. And I'll explain to you a little bit more about that in detail as I go through my presentation. So what is inflation? I actually found this definition, I think it's quite true. It's the most universal tax of all. Every single country, barring probably Japan over the last, if you ignore the last 2 years, the last 20 years had deflation. In other words, their prices were going down. But every other country, you've got prices going up. So I actually like to quote at the bottom there, the law of inflation, whatever goes up will go up some more. So it's not like gravity. It definitely won't come down. I can promise you that. It does go up. I'm going to show you a little bit about that in my next couple of slides. So let's have a look at this. This is a graphic on bread. Now, I'm not a baker by any means, but I think for the last 1,000 years, the general input into bread has been pretty similar. I know we get low GR bread and whole wheat and what now, but effectively, bread is pretty much made the same way over the last 1,000 years. It used to cost you 1985 1 rand. That same bread now costs, or loaf of bread costs you 10 rand. I think pretty much the ladies in the audience will actually attest that they do most of the shopping. I know my wife does, so effectively you will see there's been a significant increase just in the purchasing power, or decrease, sorry, in the purchasing power of your rand. So effectively what inflation is, if you think about it, it's like being broke but having a hell of a lot of money in your wallet. So you have to look at Zimbabwe. When they had hyperinflation, the literally guys could take a wheelbarrow to the supermarket to go and buy a couple of things. The paper that the money was printed on was actually worth more than the money itself. Okay, and that is what we talk about inflation. So your parents and your grandparents lied to you when they said you must take your money and put it under your bed, or under your pillow. If you do that, you will get poor, and you'll get poor slowly. But depending on a country, if you've got high inflation, you'll get poor very quickly. You've got to be able to invest assets to grow higher than inflation to ensure that you maintain the purchasing power of your rands. So I will touch on that. But what are the pressures that actually build on inflation? So I've got over here, we have a look at your wages. That's that poor little flower over there, that sunflower. And you've literally got a whole bunch of things trying to eat at your wallet, your share of wallet. Now, each single person of you will see over there, there's insurance, housing prices. You'll all know that a lot of these things actually fight for a share of your wallet. So what does government do in South Africa? So we've got Stats South Africa. They calculate what we call CPR, and that's the Consumer Price Index. But effectively what they try and do is calculate what are the effects of all the rising different baskets that we see over there, and then try and calculate that. And how do they do that? Well, they've got to do it. We've got about approximately 53 million people in South Africa. They've got to try and calculate CPR for the average South African. Now, please make sure you understand that point. I say the average South African. Have a look at the CPR basket. Like I said, CPR stands for Consumer Price Index, and it's literally the amount of inflation that you're experiencing. The latest print came out 2 days ago. It went from 5.8 to 5.9. The Reserve Bank governor, as you know, wants to keep it between 3 and 6%. But effectively, it's currently sitting right now at 5.9. That was 2 days ago. But look how they calculate inflation. I just like to have a show of hands. Did anybody here spend only 1% of their total salary on health? Anybody spend only 3% on education, or have? So the point I'm trying to make is that is the average South African. Every single person sitting in this room has your own CPR basket. Very unique to you, the way you spend your money, or your wife spends your money, one of the two. But effectively you've got to make sure, you've got to look at your own inflation. And what's vitally important is you can go into Stats SA, and they've actually got a nice little tool where you can input all your different costs that you spend your salary on. It'll then give you what your current CPI basket is, and you can track it. And the reason why I say it's important, because when they say inflation is running at 5.9 or even 6%, and if I tell you I gave you a return of inflation plus 5, that's that inflation. It's not your inflation. So it's very key, especially when you get into retirement, to understand what your inflation is. And you've got to understand that. So telling you what it is right now, why did the Reserve Bank Governor, I've just told you 2 days ago, inflation came out and it was 5.9%. It's still within the 3 to 6 band. How did Jill Marcus and a Monetary Policy Committee, how did they come out and raise interest rates and catch 20 economists that were polled before the MPC met? How did they catch them unawares that she was going to raise interest rates? I want to show you some data now that points to significant pressures building up on our economy and why she actually had no room to maneuver in terms of raising interest rates. Notwithstanding the fact that we're currently growing at about 2% in our country, and we can't really even afford interest rate hikes because we've got anemic growth in South Africa. But I'm going to show you some slides over here. Have a look at this. This looks at the white maize price. Why is white maize important? Again, like I said, we've got 53 million South Africans. The average South African has, that is their staple diet, and that is white maize. You've seen a 40% increase in the last 3 months. Yellow maize. Why is yellow maize important? This is for your more affluent person that can afford chicken and beef. We've seen a 45% increase in the last 3 months. Wheat, to a lesser extent, we've seen a 20% increase. Now, the point I'm trying to say over here, that's just the actual price of the commodity. That still has to be produced into goods. That has not been passed on to you yet. So even though you go to the shops, you have not seen these increases yet at the supermarkets. You will find it now in the coming months. It's going to come through. I'm going to show you some stats on that. So what we've got over here is there's many measures of inflation. This inflation, the blue line over there, looks at the consumer food price inflation. That's what you would pay at a supermarket. You can see it's been on a steady decline. And in fact, the other one up is what we call PPI, which is the producer price inflation. The producer has to buy those commodities. He then produces his goods and makes sure he gets it out to the market. Now, what you always find is your inflation that you would pay as a consumer lags what the producer would do. That is 5.8. The latest print at the end of January was 7%. That has not been passed on to you yet. And why will the producer pass it on to you? Well, he's got profit margins to protect. So if his profit margins are going down, the only way he can protect it is to push the price of his goods up, which means you have to pay more, which means inflation goes up. Okay, so that's coming. It hasn't come yet. The latest print on the consumer food inflation, what you pay, is now up at 5.6%. Then on top of that, you've got this nasty little devil, and every time we hear the press come out, every Tuesday, the first Tuesday of the following month, our fuel goes up. It has gone up from January 2009 from about 6 Rand a litre to over 14. At the time I put these slides together, it's 13.75. You now know you're paying over 14 Rand a litre. Now, it's a double whammy. We don't have a very efficient public transport system in South Africa, so you've actually got to get around in your motor car. That's costing you a lot, which builds inflation. And on top of that, the producers that I just spoke to you about also have to, when they produce the goods, transport it around the country. And when they transport it around the country, it's costing them more money, along with e-tolls. And they do comply, by the way, with e-tolls, not like some of us do on the individual capacity. So companies will, and what do? They build it into the price, and then it feeds into what you're going to pay. Okay, so these are all the pressures the Reserve Bank governor is looking at and knowing it's coming and it's going to hit you. So you can see it on the horizon. Then there's the nasty, what we call medical inflation. So I don't know if there's any medical practitioners over here. You can see they constantly live way above inflation. So, if you look at that, it's constantly been about 10 to 11%. Yes, it's come down a little bit to 9.2%, but it remains stickily above the 3 to 6 band. Sometimes even double what official inflation is calculated in South Africa. Why is that important for people getting to retirement? Because in your twilight years, medical becomes the biggest spend that you'll actually spend your wallet on, basically. So more and more so, this is going to become a big burden in your life in terms of how much you've got to pay for medical costs. And it's important that you understand that number, because when I'm saying inflation is running at 5.9, just medical inflation is probably sitting at about 10. It's important you understand that. And administered price inflation. Unfortunately, it's something that's administered on you. So I don't know how many people have got their own capacity to generate electricity, but when Eskom puts up the rates, we basically have to pay them. If you don't pay your water bill, what happens? They cut your water off. So these are administered on top of you. And those in themselves, you can see, have been above that 3 to 6 band for a long time, which is creating a lot of inflation in the country. Then, of course, we've got taxes. I don't know if a lot of you can read some of these taxes over there. But these are just some of the creative ways in which government goes out and taxes you. They call it duties, levies, tolls, tax. I don't even know if you're paying half of these, but a lot of the times, every time you just get in a plane and fly, you're paying airport tax, for argument's sake. But the one in the middle over there, sort of floating around, you can see the fuel levy. Praveen Gordhan came out recently in his budget speech, and he had to raise the fuel levy again to finance certain things. Again, that in itself feeds into the petrol price, which again feeds into you paying it at the pump, plus your producers paying it, which feeds into inflation. So again, it's inflationary nature. But again, these are all the creative ways, and again, it's all fighting. You've got all these, it's like having 10 kids trying to fight for your share of your wallet, and literally that's exactly what's happening. Okay, and again, it's inflationary nature. So what do central banks do around the world? There's a thing called monetary policy. Monetary policy where effectively central banks around the world can target inflation rates, so either increase or decrease demand in a country. Okay, so that's pretty much what central banks do around the world. They've been doing that for probably close to 100, 200 years. Then there's this new thing that's been coined by the West, because when Zimbabwe did it, they were called printing money. But when the West does it, they call it quantitative easing. It's a lovely name. I want to talk to you about QE. It's already, you've had QE1, you've had QE2, you've now on to QE3. China's doing it, Japan's finally starting to do it. They actually coined a phrase for what Japan's doing, that's Prime Minister Shinzo Abe. They're calling it Abenomics. He's got his own thing. You can Google it on Wikipedia. You can go into it. It says Abenomics, and that's his version of quantitative easing. But now I'm going to go into some very technical slides, so please pay attention. I'm going to try to explain to you what quantitative easing is. Simple. It's printing money, throwing it at a problem, and hoping for the best. Okay. That's about as technical as we're going to get on that. But really, effectively what it is, we don't understand what's going to happen in the next 10 to 15 years. They'll write stories about what is happening now, but we've seen unbelievable amounts of money that has been pumped into the world economy. If I just take the US alone, on quantitative easing version 3 that we currently sit at, they were 85 billion US dollars into the economy every single month. That's almost 1 trillion rand, which is about 30% of what we produce on an annual basis, this whole country. They're pumping it into the economy every single month. Why are they doing it? You see these two people over there on their, they're flying brooms. The gentleman is Ben Bernanke. He's the outgoing Fed chairperson. And all those for ladies, ladies lib. Janet Yellen was the first lady to ever now run or chair the Fed. She's come in and very much continued doing what Ben Bernanke's been doing. Okay, what is they doing? It's dropping money into the economy. And they've done it quite successfully. Now, those two individuals claim to be very ardent students of the Great Depression. And it's important you understand their psyche. America's biggest national scar was the Great Depression. It started in about the 9th of September, 1929, but the big day came on the 29th of October, 1929. The markets fell by 30%. It was called Black Tuesday. That was really what kick-started the Great Depression. And the only time the markets actually fully recovered was 10 years later, back to the pre-crisis levels. Okay. They've been very critical of the way that the government at that time, the Fed, responded. So what they said, the Fed responded too late, they weren't drastic enough with their measures, and they didn't administer them for long enough. So what they've said, they will do whatever it takes to make sure the American economy doesn't go into a Great Depression. And when did this all happen? If you remember 2008, the global financial crisis, when a company by the name of Lehman Brothers, over a 100-year institution, went under. Still coined the phrase, too big to fail. They failed. Then the governments around the world, you remember Northern Rock? There were still pictures of people queuing up in Northern Rock trying to get their money out. the UK government had to step in and save Northern Rock, and it happened across the world, had to save their banking systems. Okay, and that is the global financial crisis. So why are they pumping this money in? Well, the American economy, after the 2008 financial crisis, was literally on its deathbed. Anemic growth, high unemployment. Unemployment went up to 12% in the US. By the way, in the Great Depression, it got up to 25%. It got up to 12%, so it was significant. And also, housing fell off a cliff. Housing prices literally fell off a cliff. So they had to do something. And what did they do? They said, let's pump all this money, which they call quantitative easing, to get the economy back onto its feet. Okay, and also then make sure that we shore up world capital markets. And did this work? Yes, it did. Have a look at what the economist comes back there. Comeback kid, typical American style, quite flashy. They've come back. Unemployment has gone from 12% in the US down to 6.5%. It's just recently ticked up to 6.7%. But unemployment is definitely under control. Housing has definitely recovered. Corporate earnings are recovering. The US economy is starting to look good. But what has it meant for emerging economies like ourselves, Brazil, India, Indonesia, Turkey? It hasn't meant, it was very, very good in the days when they were pumping money in, and I'll explain to that why. But things have turned a little bit sour. So you see these little babies over there, and that man over there is Ben Bernanke. And he's basically saying to them, stop crying. Because we as emerging economies are now saying we're crying. And I'm going to tell you why we're crying. Because this great 85 billion that he's been pumping in every single month, he came in the month of May last year, and he said, I might potentially consider tapering. In other words, instead of pumping 85 billion, I'll put in 75 billion. The markets around the world capitulated. Markets were down significantly on the day that he mentioned that and the following days. He then came out and said, guys, all relax. I think you misconstrued my words. I didn't really mean that. We'll continue putting money in. The markets all recovered. But come November last year, he got serious. He says, the economy's back on its feet. Unemployment's under control. I'm now going to taper back on pumping my 85 billion in. And I want to do that slowly. So in January, he took off 10 billion. So instead of pumping 85 billion, he's pumping 75 billion. In February, he took another 10 billion out, and now he's pumping 65 billion. And I just read last night they met. Janet Yellen came out, and they've cut by another 10 billion. You saw the rand depreciate by 1.5% last night alone because of the fact of that comment alone, and they've now tapered it down to 55 billion. But you're asking me, that's America. Why the hell is that important to me? Well, when they had all this 85 billion into the market, into the US economy, and by the way, China's doing the same, and so is the Eurozone, and so is Japan, people are saying, well, where do I go and find yield, return on my money? Interest rates in America, I wish I'm sure we'd love interest rates like this if you're borrowing money, not the people sitting in this room that actually want to invest money for the long term. The interest rates are at 0.25%. So it's basically zero. So I can borrow money in America. Basically, the bank's saying, just take the money. I don't have to really pay interest. I can go to South Africa, I can go to Brazil, I can go to Indonesia, Turkey, and get interest rates of 8, 9, 10%. That sounds like a pretty good deal. Loan at nothing, make about 8, 9, 10%. And that's what happened. So a lot of this easy money was then flowing into these emerging economies that you see over there, causing their stock markets to rise, causing their currencies to appreciate. It was good for all of the rand. The rand strengthened quite significantly. Our bond market looked good. So everything was happy days. The problem is when he says, I want to start tapering, investors start getting a little bit jittery. They don't like the riskiness of emerging markets. They start pulling their money out. Now, the problem with those 5 countries, you should include Turkey over there, is they are part of an elite group. We're one of them, and not a very nice elite group, but we're called the Fragile 5. And why is this important? Because the Fragile 5 over here, we've got a current account deficit, which means we're importing more than we're exporting. And if you're importing, it means I have to sell rands and buy dollars. When I sell rands and buy dollars, it causes my currency to weaken. Okay, you actually want an economy where you're exporting more because it does support the strength of your currency. Okay. The second one, like many of us over here, we're spending more than we're making. In other words, government is spending more than what they're taking in from a tax revenue point of view. So if government wants to finance infrastructure works, whatever they do, they have to go and borrow money. And when you borrow money, it costs you more, depreciates your currency, and you can also have potential for credit downgrades. We've got down to like BBB. It's always a problem in terms of how we actually fund that current account deficit. So this is bad for our currency. as it stands. This show, remember I told you in November, remember I told you just in May, he came out, Ben Bernanke, and said, I might potentially start tapering. This shows you the flows of international investors, money into our stock market, into our bond market. Just on those comments alone, money flew out of our economy significantly. These are in billions of rands. In the last 3 months alone, because he has actually started tapering, or now Janet Yellen just after him, 70 billion rand has flown out of our economy. It's investors' money. They can literally rip it out. And what happened to the rand? The rand went to 11 rand 30. It somewhere went down to 10 rand 60 after we raised interest rates. I'm going to talk about that. But now, after what's happened now by tapering again, which Janet Yellen did another 10 billion, we saw the rand get to almost 10.90 last night. Just on that news, it lost 1.5% overnight. Okay, so this is why we're very, very fragile from people pulling money out, and it affects us. And why is it bad if the rand weakens? Because inflation comes into effect. Because we're importing stuff. I showed you we're importing more, and if your rand is weakening, it means costing you more to import, which means inflation goes up, gets passed on to you and I. So this shows you what happened to the rand and a couple of those different currencies. The rand is in red. Turkey, by the way, is in black. I just wanted to show you how, and when the line's going up, it means that the rand is depreciating. You see in the rand, this is just in 2013, how significantly the rand has depreciated. And the same what you're seeing with the Turkish currency over there. And like I said, it's all the emerging economies. Those fragile five are all weekend. Okay, so but what's important is you'll see when that black line right at the end actually dips down. We raised interest rates by 50 basis points, in other words, 0.5%. Turkey raised interest rates by 450 basis points, 4.5%. How would you like it from an own budgeting point of view if the Reserve Bank governor said, let's put up interest rates by 4.5%? Why did they do that? Because they had to protect the currency. Because now, if I was only making 8%, if I'm borrowing money at 0% in the US, making 8%, all of a sudden you raise it by 4.5%, now I'm making 12.5% interest, and I'm borrowing it at 0, it actually makes sense. Okay, and that's why they did it, and that's why we had to raise interest rates as well. But what's also quite scary is the Reserve Bank governor is looking at the current situation. She's now looked at headline CPI and core CPI. What is headline CPI? Is the one that I told you about that gets published, that little round, that pie chart I showed you. That's currently sitting at 5.9. What is core? Core strips out the volatile food and energy prices. Once you strip that out, okay, that actually looks at basically the rand base effects of inflation. And with the depreciating rand, we've seen since 2010, it's just been trending very, very straight up to that 6% band. So with this in mind, she actually had no room to maneuver. She had to raise interest rates. And that's what she's done. So now that I've actually completely depressed you, and you want to stitch your wrists ahead of the long weekend, let me just say to you, we've been here before. It's a normal business cycle. I actually borrowed this from our chief economist, Chris Hart. He put this together because I'm a simple guy, and he tried to explain to me how this whole thing works. Okay, so you sit over here, you've got a depreciating rand, like we've currently found. If you've got a depreciating rand, what happens when the rand depreciates? It pushes up inflation because your producers are importing things at a higher cost, so it pushes up their inflation. If their inflation goes up, what happens? They pass it on to you as the consumer. So CPI goes up. If CPI goes up, what does the Reserve Bank do? Sorry, the Reserve Bank governor, she raises interest rates, which then decreases demand, which then decreases GDP. In other words, we'll start importing less because we'll have less money. And if we start importing less and exporting more because our currency is weakened, it helps our trade balance, which helps our balance of payment with each of those trading countries, which then causes the rand to strengthen. And when the rand strengthens, our imports get cheaper, means the producer's inflation goes down. They then pass that on to you. Inflation goes down, which means we can decrease interest rates because inflation is coming down, which means demand goes up, GDP improves, trade balance decreases again, and then we sit with our balance of payments decreasing. So it's a normal business cycle. I spoke to Chris Hart. He reckons we'll probably be in the first half of next year. So it's something that we see all the time. So let's not get despondent about it. Okay, so just in concluding on inflation, I'm going to talk to you about how we slay the monster of inflation. I just wanted to give you some context about what is inflation and why do you invest in different asset classes and how do those different asset classes affect inflation and how are they able to beat inflation. So how do we actually build a portfolio for you? Well, I wish it was this easy. I could literally just plant it and we can grow the money. That would be fantastic. I think some people in Colombia and stuff, they do plant stuff and grow it to make money. But effectively, yeah, we're talking about real investments. So what is an investment? It's literally a trade-off between how much risk you want to take on and how much reward you're going to get for that risk. But I just want to make a point that there's different measures of risk. Okay, so one of the risks I'm going to show you is just volatility. So in other words, things can go up and down. But you also get another risk which is important to you, is the risk of not beating inflation. Okay, so I want to talk to you about the different measures here. So I put this over here. We've got your high stage growth. That is very much what John Anderson told you about. While you're working, you're trying to accumulate as much money as you can. The most important part comes pre-retirement and post-retirement. Because whilst you're working, you can take a lot of risk. You can try and be in a volatile asset class like equities or the stock market. The market can go up and down. You've got a long term to recover. The closer you get to retirement, you've got to be a little bit more conscientious in terms of what is your investment strategy. And why it's important is that pre-retirement, before you retire, you don't want to be in a portfolio that, say, for argument's sake, has only got 25% allocated to the stock market. I'm going to go into detail what I mean by that. 25% and the rest in bonds and cash. But then after retirement, you sit down with your advisor, you go into a portfolio with 50% in the stock market. You've got to try and align your pre-retirement strategy with what you're going to do when you go into retirement. And that's why it's vitally important during this phase over there, pre-retirement, you start consulting a financial advisor to make sure that your financial affairs are in order for when you go over to retirement. It's vitally important at this stage. So then, I'm going to chat about asset classes quickly. These are the four main asset classes. There are some alternative things like trading in commodities and hedge funds and whatnot, but these are the four main asset classes. And that's equities, as literally being a share owner. So you can go to the Johannesburg Stock Exchange and actually buy shares in ShopRite if you wanted to. Property is no different to the property that you live in. So if you're living in and you own your house, that's your property of your house. But you can also invest into things like rental income. So you can actually go and buy a townhouse, for argument's sake, rent it out, you get rental income. So there's different ways you can own property. I'm going to go into detail about this a little bit later. Bonds is literally an IOU. It's where you can actually loan money to a corporate or to government or to a municipality, and they're going to give you a certain rate of interest, which is agreed upon in terms of a contract. And cash is simple. It's like cash putting in the bank, and you earn interest for the amount that you got in the bank. So what I try to do is just show you the different asset classes. Now, remember I told you there's different measures of risk. You've got reward over there, so showing you equities give you the highest reward, risk at the bottom, but also the highest risk. But the measure of risk I'm using here is volatility. It's like a roller coaster. Markets go up, they go down, they go up, they go down. Over the long term, I'm going to show you that it's actually gone up, but it's the most riskiest asset class from a volatility point of view. Okay? Property, government bonds sit somewhere over there, and cash, you can see, gives you the lowest amount of risk, but also gives you the lowest amount of return. I'm going to unpack this a little bit in more detail for you. But if I had to say the measure of risk was inflation, in other words, what is your likelihood that you're going to beat inflation by investing in any of those asset classes? You could actually swap that whole thing around. Equities would be the lowest risk investment because it has the highest possibility of beating inflation. And cash would be your highest risk because it's probably got the lowest, and it does have the lowest probability of beating inflation. Right now, as we stand, inflation is higher than what you can actually get from your bank, significantly higher. So if you put your money in your bank, you're actually going backwards in the purchasing power of your money. And the only way you can preserve that is by investing in these other more aggressive, riskier asset classes. So what is cash? It's simple. It's money in the bank. It's short-term money. You're earning interest on it. Okay, and the very important point why you want cash in your portfolio is it's liquid. If I need to draw money now and I need to actually pay myself a pension for the month, you'd rather draw it out of your cash reserves. So what are the pros? Like I said, there's no capital loss. And pre-2008, if I was standing here and this is 2007, I would say to you, there's no way you could lose money in cash. Well, you can. Lehman Brothers went under. Northern Rock, you saw those people queuing up. Why were they queuing up? Because they were afraid they're going to be able to get their money out. Okay, and that happened to quite a few people. They couldn't actually get their money. They had to take what we call a haircut. If you had, say, 100 Rand, it would only give you 80 Rand for every 100 Rand you had. You can lose money in cash, but it's highly unlikely. That's why they say it's the safest investment. By the way, South Africa is ranked number 4 by the IMF in terms of our banking system in the world. We've got a very robust, very, very strong banking system. Okay, so the only way you could lose money, basically the top 5 banks, so the big 4 plus Investec had to go under, you could lose money, but typically very, very safe investment. Big point though, it's unlikely to beat inflation in the current environment right now. You're getting less from cash. Unless you've got some money market managers who use cash and cash instruments, which are more shorter dated type instruments, they can actually beat inflation a little bit more. Bonds can be very complicated. And it doesn't start out complicated, but we make it complicated because we want to make different types of money on these things. So how does bonds work? Effectively, like I said, if you've got a municipality or government, and say for argument's sake they want to fund a new power station, they don't have the money, so they issue bonds out, you can go and buy one of those bonds. So in other words, you're loaning money to government. And say the bond was $1 million, you loan government $1 million. That bond says they'll pay you, say for argument's sake, 10% interest per annum. And it's a 20-year bond, they'll keep paying you 10% for 20 years. And after 20 years, you get your R1 million back. That doesn't sound difficult. Except, we actually like to trade bonds. So you can go to the bond exchange of South Africa, and you can actually go and sell your bond. Other people will buy it. Okay, what determines the value of that bond is determined on the interest rate cycle and the inflation cycle you're in. So if you get that call wrong, you can lose a lot of money on bonds, and I'll show you some slides of that. But if you get it right, you can make a lot more than what's stated on that certificate in terms of the 10% return. The nice thing about bonds as well, it is a very low correlation to equities. In other words, if equities are going up, it doesn't necessarily mean bonds are going up. And if equities are going down, typically if you have a stock market crash, bonds do well. So it's nice to have it in your investment strategy so that you've got different asset classes doing different things in different market cycles. Okay, it helps you diversify. Property. Again, like I said, you got your house, you invest into your house, and if you pay your house off, that house is actually worth nothing to you in retirement. Because if you've got this big 4 or 5 bedroom house because you had your kids and now they have finally left the nest, and you're sitting in this house, you and your wife, well, firstly, it's a 4 or 5 bedroom house. Do you need it that big? And secondly, it's actually worth nothing unless you sell that big asset you built up and move to a smaller house and realize the capital and invest that capital to help you pay a pension. But while you're sitting in the house, it's actually worthless to you. So it's a concept you've also got to get your mind around in terms of, what is the actual value of the house you're living in. You can also then, like I said, if you want to go buy rental property, you can go and buy a couple of townhouses. I remember about 2001 or 2002, I bought my first townhouse. It cost me 220,000 Rand, 2-bedroom, 1-bathroom. A similar size one now will cost about, 800, 900,000. So we've had that's a 4-fold increase just in the price of that townhouse. So you can get, if you buy a townhouse and you rent it out, you can get the capital appreciation. Plus, I'm getting a monthly rental income. Okay, so that's a nice way to invest in property. Another way to invest in property is through what we call listed property. That's where effectively you buy shares into a company. That company's job is to have a portfolio of underlying industrial and commercial property. Like if you look at Sandton City, Liberty is probably about, I think, a 70% owner of that. So if you buy into one of their property stocks, you own a portion of Sandton City and all the people paying rental income. Okay, so that's how you can actually invest in property. So the pros of this is it definitely is better than bonds in terms of the returns. I'm going to show you some returns. We've had stellar returns over the last 20 years, been phenomenal. Also has a low correlation. It tends to operate similar to bonds in terms of the cycle, in terms of when it does well and when it does bad. The problem with it is cyclical. And right now, I'll probably argue, and this is my view, nobody else at Investment Solutions, I'd argue that in the property stocks, we're probably in a bubble. And you've seen property come off significantly in the last 3 to 5 months. And it can be liquid. If you bought that townhouse that I was talking about, and you actually now need to sell it because you need money, it could take you 3 months, 6 months, 10 months, unless you're willing to take a lower price than what you think the property is worth. So it can be liquid. And then there's another problem with property. Bruce Cameron has written a number of articles. In fact, you can find it on Personal Finance, and they're targeting pensioners at an alarming rate. Because we've come out of a low interest rate environment, pensioners have been trying to fight for yield, trying to get some return on their money. These guys target pensioners and market these great things called property syndication trusts. It's a lovely terminology, but it's a scam. And the reason why it is, it's nothing more than what we call a complex legal pyramid structure. And like I said, if you want some more detail, go onto the Personal Finance website and you can read up on about it. But effectively, you get these guys, really, really good salesmen of note. They'll come there and they'll sell you all about how this property syndication trust, where effectively you become a part owner. They'll even fly you into a piece of land and talk to you how they're going to develop all this land. You pay your money in. They take up to 25% commission. They promise you returns of like 20, 25%. And I can assure you, you're not going to get 20, 25% anywhere. They promise you that, and maybe after the first year, they give you your money back, because what are they doing? Is the new investors that are coming in, they're paying you from their money. And before you wipe your eyes, they've buggered off with their money, and you've got a piece of land undeveloped, and you've wasted all your savings. So I think it's vitally important that you don't get caught up. A lot of these things, rather approach a financial advisor, a reputable financial advisor, make sure you're well aware before you actually get involved in these type of things. And those are just some of the recent examples of property syndication trusts that have blown up in South Africa. Okay, so equities, what is that? Effectively, you're a shareholder in the stock market. Okay, so you're a shareholder, in a company which is listed on the stock market. So effectively, if you think that South African retailers are going to do well, you can go buy Shoprite, Checkers, Truworths, Mr. Price, you can go buy whatever stock you want, and you're physically an owner of that company. You might only be 1/1,000,000th of an owner, but you're still an owner, and you're entitled to the profits and losses of that company, so the profits in the company are there, or the losses are there, you participate in that. And as part of a shareholder, you're allowed to attend general meetings, you've got certain voting rights, and you're also entitled to something called dividends. And I want to make sure that you understand that. So the nice thing about equities, it can also give you capital appreciation. MTN was probably listed about nine years ago at about 35 Rand. It went up to 200 Rand. It's probably sitting about 160, 170 now. If I sell that share and I held it on all the time, I can realize a massive capital appreciation because my share price went up. But also if I held onto that share, they declare dividends. Now what is dividends? If a company creates a profit, they can either look at that, the directors will sit around and say, well fine, do we actually then try and grow into new markets like MTN have done throughout Africa? Or they can say, well, let's just give the profits back to the people who own the money, which is the shareholders. So they declare a dividend. So if you've got 100,000 shares and they declare a 1 Rand dividend, it's 1 times my 100,000, I get 100,000 Rand worth of income paid to me. Okay, so that's vitally important. And you can take that money and reinvest it. And you heard Jenny talk about the power of compounding interest and why that's important. Again, that just feeds up and obviously gives you a lot more growth in your portfolio. So it's important you understand that. But this is not for sissies. It is the most volatile asset class. And I promise you, if you watch it daily, you'll give yourself a heart attack. The markets literally bounce up and down daily. You can be up 1% today, down 2% tomorrow, up 3% the following day. It really, literally is. You've got to see through that cycle, and I'll show you some slides on it now. So what I've done over here, as I said, if you invested 100 Rand over 10 years, and you put it into bonds, which is the dark blue line, cash is red, the South African stock market, which is the one in purple, and the light blue is SA property. Like I said, in the last 20 years, we've had a massive bull market. In other words, a very, very good market for property in South Africa. You've seen that. If you had 100 Rand, it would have grown to 780. That's listed property. Go look at the stock market giving you about 600 Rand. But look how volatile those lines are. You can see over here, when this big downturn you see over here, that was in 2008. Markets pulled back quite so significantly. But you can see over the long term giving you good returns. What does it look like over 20? Property has been unbelievable. And this is why I still think personally that we're probably in a bit of a property bubble. And again, we've seen that come under pressure in the last 3 to 5 months. Look at the stock market, look at bonds and cash, give you consistent returns, but you're not really in for a bumpy ride. Now look at over 40 years. The average person will work for 40 years, and your average post-retirement will be about 30 to 40 years as well. We spoke about longevity rates, and John Anderson, he's not around here right now, but he will talk a little bit about the first person probably to live to 150 is already 50 today. So that's going to have a major impact. So look at 40 years. Stock market, if I invested just 100 Rand, it would have grown to 107,000 Rand. Property, 84,000, and look at bonds and cash. Very close. And that green line, by the way, what cost me in 1973 100 Rand will now cost me 4,186. So remember I talked about the reducing power of your money? That's what inflation does to it. So what this does is this actually then takes the Johannesburg Stock Exchange. By the way, a friend of mine actually made a killing on the stock market a couple of years ago. He shot his stockbroker. And the reason why I want to point it out is because what drives a lot of your investment decisions is fear and greed. Have a look at there in 68, 70 at negative 15, negative 31%. You can see over there in, like I said, 1960, you've had 2 significant years of negative returns. What do people do intuitively? They pull their money out and they sit in cash. The problem is when do you get back in? You can see it's a very, very bumpy ride. But like that trend line that I showed you, and I'm going to go back, if you stay in the long term, you do get the benefits of that. But it can be choppy. Very, very choppy. And again, look at bonds. So people think you can't lose money in bonds. Just have a look at it in 1994, just as we became a free democratic society. Look at it basically down 19%, but look how strongly it recovered. So bonds, you can lose money, but it's not as choppy as what I've shown you in terms of the equity market. And this is where you can make money by trading bonds. That's when it gets complicated. So just to basically sum up for you, beating inflation, I'll put a question mark on cash. Those other graphs I showed you, we have beaten inflation. Cash has beaten inflation and beaten quite comfortably, but that's when we had high interest rates. The current environment we're sitting in, inflation is high, our interest rates are low. Cash right now is not beating inflation. And if it's not beating inflation, so if something goes up by 6% and you're getting a return of 5%, you've lost 1% of the value of that money. Okay. Property, bonds, stock exchange over the long term I've showed you does beat inflation. So what does it mean for you? Well, what are the risks? So a lot of this will be covered by Andrew Leventis in his presentation, but what are the risks? I've put up the inflation, as I told you, is a big risk. You've got to get your mind around inflation and go to the Stats SA site to try and actually find out what is your own inflation and try and track that. You've also got how long you live. Now, I actually showed that slide to Bruce, and Bruce said to me, that doesn't look like an old man, it looks like a 40-year-old that's done too much drugs. So, but then again, he's not going to have to worry about longevity. He's probably going to die at like age 55, so he doesn't have to worry about retirement planning. But effectively, how long you live, you have to take into consideration market risks, and also vitally important is consumption. And Andrew will hit on a lot about living annuities and how much you can draw down from your living annuities, and that's important, how much money you actually be taking from your retirement fund assets. I was going to take you, how's it going? I just want to take you into a quick video to tell you how do we actually put this all together for you.
People who want to invest often wonder where to begin. The more important question should be, where do you want to end up? And to get there, what's the best strategy? If you're thinking short term, one option is to go low risk to preserve the value of your investment. Just don't expect fireworks or huge returns. Long-term investing can be rewarding, but it's also a bit more complex. Inflation quietly gnaws away at your funds, and one way to beat it in the long term is through growth assets such as shares and property. With time, these investments have the highest potential to offer returns that outperform inflation. But you have to give them time. Don't let yesterday's news dictate decisions that will last a decade. Investing is an art, so forget the science that says what goes up must come down. In the long term, all shares experience ups and downs. If you sell every time things go south, you'll never benefit when they bounce back up again. Short-term highs and lows are not a clear reflection on the true value of an investment over time. Recognizing underlying worth and creating solid strategies requires insight, experience, and in-depth understanding. These are all values that are part of our investment DNA and just some of the reasons why we are South Africa's leading investment solutions provider. Investment Solutions is an authorized financial services provider.
Okay, so I've got up and spoke to you about asset classes and investment strategies, but really that's probably the last part of where we really get to. So what I've put up here is that this is why you need to consult a financial advisor. You need to understand what your needs are in conjunction, and it's probably the best is to do it, and Andrew will touch on it, you and your spouse, to understand what your needs are. You need to design a plan to get you there. And then only then do you look at what is the most appropriate investment strategy. So you shouldn't be looking at investments first. You first need to go through those planning phases, and then you must continuously monitor and manage and review that investment strategy and that advice that was given through to you. And then I'd just like to leave you with something a little bit more positive. Destiny is no matter of chance, it's a matter of choice. It's not a thing to be waited for, it's a thing to be achieved. So you have the power in your hands to make the right decisions. So I just want to leave you there, and thank you very much for your time.